Last week we talked about a tug of war between bulls and bears. Kind of the same. Let's look at the leaderboard this week for the past week. Number one, let's just get this out of the way. This is BNDX. It's the Vanguard International Bond ETF. This to me isn't really a grassroots thing. It looks like a model portfolio trade going into it, probably Merrill. But that does show a little aggressiveness in the fixed income department, although BNDX still $8 billion for the year. A lot of people do like this one. It's fifth overall. But to me, here's where we get to the sentiment this week, which is low vol, right? Minimum volatility ETFs, quality. Then you've got the broad market and then some gold. That, again, talks about this cautious optimism that we're seeing when you go into equities and also the gold purchase. Let's look at the outflows here to see where people are coming out. Remember a couple weeks ago, Marianne Bartels was on and said that small cap rally is probably going to die? Well, she was right. Small caps are basically down worse than the S&P over the past couple of weeks. IWM seeing the outflows because of that. But look at elsewhere. That's short-term debt and that's short-term debt. So to me, this talks about a little bullishness. You wouldn't sell cash if you didn't have some optimism here. Now let's take a big step back and look at the third quarter because that has ended and just talk about the fixed income equity race that's been so interesting. Here's total ETF flows. Here's equity and fixed income. So you can see fixed income has been better in the first quarter, a little better in the second quarter, and almost tied, though, in the third quarter. So equity slowly chipping away at the lead. Right now, fixed income has a $40 billion lead, but that was as high as $60, $70 billion. So, Scarlett, if there's some bit of good news and we see some trading crowd reaction, we could have a photo finish between equity and fixed income. It's sort of heading that direction.
And a potential regime change as well. All right, Eric, let's bring in Will McGough. He is CIO of Retirement at Stadion Money Management, as well as Carolina Wilson, who covers emerging markets for Bloomberg News. Will, let me start with you because the recent data, the economic data, has renewed a lot of growth fears here in the U.S. Eric showed us how there isn't necessarily a lot of conviction for risk versus havens right now. What are you seeing?
Right, Eric. The flows tell all because money drives price movements. And what we're seeing is gold, Minvol, bonds coming into favor. And I don't know if Q4 of last year has spooked investors or not, but that's certainly on their memory. Could it repeat this quarter?
Good points. Of course, Carolina, let's talk about China as well. There's a Bloomberg scoop that the White House is considering ways to limit U.S. portfolio flows into China. Obviously a big headline there, but what does it mean for EM ETFs?
So it's definitely interesting and important to digest what's at stake here for these U.S.-listed ETFs with Chinese stock exposure. And if we take a deeper dive and look at the numbers, there's about $550 billion in emerging market ETFs and mutual funds that are U.S. listed. Now, with roughly about 20% of the exposure in those strategies to Chinese stocks, we're talking about the headline number over $100 billion of Chinese stock exposure in these U.S.-listed vehicles. And it's actually a pretty interesting week for the Chinese markets and for these China ETFs listed in the U.S. because the local market there is closed. And I love when there are instances like this because I think it gives these single country ETFs sort of like center stage or their time to shine because they really do step in as price proxies. And even though we won't see the market makers sort of resume their normal roles of creations and redemptions, and we could see a dislocation between the price of these funds and its net asset value, it'll be interesting to see where those prices open and if it's in line with those ETFs. And the funds there to watch are MCHI, FXI, Asher.
Now, speaking of FXI, I went through your 13F, which I love doing. You own FXI. And we also shown some emerging market ETFs you own. You own about 4.
Right.
And they all have a good chunk of China.
Right.
How nervous are you? Do you see this as just hot air, or is this something you're really looking at and you might sell out of these?
Well, to put them into context of how we own them, it's in relative to the global equity portfolio. So China comes out to be about 3% of a global equity. So even though you're looking at just line item EM exposure here, it is a smaller percentage of our portfolio overall. And what you'll see is there's passive ETFs, and then there's a multi-factor QEMM. So we take our EM exposure and roughly have half of it passive, where we're going to track the benchmark, and the other half is going to be an active multi-factor, which tries to reduce volatility. So it's one play to kind of quell the concerns you mentioned is through the multi-factor approach.
Interesting strategy there. Now, another big theme that we've really been following this week, Carolina, is the never-ending fee wars. Charles Schwab is getting rid of commissions on all U.S. equity and ETF trading. Feels like this was a long time coming. How are they going to make up for that?
So I think it'll be interesting to see what competitors do for this. But yesterday, we saw shares of some of the largest online brokerages really take a hit. with Schwab unveiling these plans to eliminate commissions for U.S. stocks, ETFs, and options. And then after the market close, TD Ameritrade comes out introducing zero commissions for ETF and options trading. So these are, like you said, Scar, the latest moves in this ETF fee war. And I think it'll be interesting to see, how long it takes competitors to sort of catch up to this.
And the hope, of course, is that they will add more customers as well, Eric. Schwab's move, a huge talking point for everyone on FinTwit, including you. Didn't you take a poll of everyone on asking how long it'll take before everyone follows suit?
Yeah, I did this last night at 8 p.m. because I have no life. Basically, the respondents were interesting. People generally see that Fidelity, which is the big enchilada here, we're curious what they're going to do. Are they going to go to zero? iShares has a deal with them where theirs are commission free. Will BlackRock step in and stop this? And it's really interesting. Will, what's your take, A, on the free trading and also Fidelity's, the prospects of them cutting to zero too?
Right, yeah. Fidelity was obviously the odd man out on y'all's chart of free ETF availability for trading. And it's just a general industry trend. Asset managers have gotten fee compressed thanks to Vanguard. And now this is, as you said, the Cat 5 hurricane coming through and taking it to custody and trading at the retail level, which is great. Now, the problem is going to be is what are advisors on Fidelity going to do if Fidelity does not react and do the same thing? There's going to be an interesting decision there. Do you go to where the trading is free, or do you stick with Fidelity and pay extra for presumably extra services that they offer? So it's going to be very interesting to see if and when Fidelity does react and how they react, mentioning that BlackRock deal that you talked about earlier.
What about the prospect of consolidation in the discount brokerage space? Talk about E-Trade having to team up with TD Ameritrade. What would that mean?
It would be interesting because E-Trade just bought the firm out of Denver. I'm drawing a blank on. To get into the RIA space themselves. And so if they pair it with an RIA-based aggregator like TD, it would be great for them. But they get a lot of their margin just like IB does from commissions. And these apps are killing them. Robinhood, Acorns, robo-advisors, it's all going to zero. So you got to make money somehow else.